This is the Evidence-Based Investing Podcast, the show that challenges assumptions and puts every strategy under the microscope. We bring in the experts, we bring the facts, and we break down what actually works depending on where you are in your wealth journey. If you want hype, this isn't your podcast. If you want the truth, well then welcome aboard. The information in this podcast is for educational purposes only and does not constitute financial, tax, or legal advice. We discuss general investment concepts and share case studies, but your personal situation may be different. Always consult a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results. Welcome to the Evidence-Based Investing Podcast, powered by Retained Property. I am your host, Luke Ryan, and today we have a very exciting episode. Well, at least for me. This is where we're going to talk about actually shortlisting suburbs. How do you find a good suburb amongst the 15,000 in Australia? How can you do it in a short amount of time? What are the key indicators you need to look out for? I remember when I first got into my property investing journey, I knew that everybody said it's supply and demand, but what is a supply indicator? What is a demand indicator? What correlation do they have to growth, whether it be short-term or long-term? What correlation do they have to rental yields? What ones are more important than the other? Are they the same no matter what your brief is or what the asset is? I'm going to try and give you some clarity on all of this today. Now, I will warn you up front that there is a lot in this episode. This could be one of the episodes that you need to listen back to a few times. And I am going to dive into a lot of the nuances, a lot of these indicators in a lot more depth in separate episodes, because there's only so much you can cram in to an hour or so podcast, however long this takes. Now, I want to start this off by talking about how different suburbs, different areas move in different cycles. Sometimes you have charts that go up nice and steady over a very long period of time, but if you have a look at suburb growth charts over a long enough period, they're usually going up and down a little bit, or at least going up and then flattening off, but they very rarely just go up at exactly the same rate every single month. Now, what this gives us the opportunity to do is, if you know how to read the data and you have looked and done regression analysis, or at least learnt the methodology from people that have been in this industry a very long time on how to look at the different indicators and work out what they mean to increase the probability of a particular outcome, it will get you a very, very long way. Now, nobody's got a crystal ball. No one's going to be able to tell you that next year this suburb will grow by 10%, or over the next 5 years this suburb will grow by exactly 26%. Like, that's just not possible. There is too many things that happen in the world. For example, interest rate changes or changes in immigration policies could really, really make a huge difference. But you can increase the probability of a particular outcome. You can look back in time and say, what were the fundamentals of these suburbs that moved the way that they did? And how many suburbs did move like that? Is that significant evidence to make the assumption that it's likely to happen again in comparison to this other suburb which does not have the particular fundamentals or the particular key performance indicators that the others do or do not? Now, I want to give you a bit of an example that I often tell my clients so that it gives it a perspective, right? It does come down to supply and demand. And there is different ways that we can look at how much supply is coming to the market and how much demand that there is. One of the major ones is population growth. That is obviously a demand indicator. If there is a lot of people going into an area, that means there is a lot of demand. And if the supply is not keeping up, which we can look at through things like building approvals, or just knowing that there's simply not enough trades in the area, which we've seen in many suburbs around Australia at the moment, that if the supply doesn't keep up, then there's going to be more and more people bidding on each property because there's going to be more demand than there is supply, and therefore it will drive up the price. Got more people at the auction bidding. You've got more people in the multiple offer situation bidding.
It just keeps moving up and up and up. And this is what we've seen in a lot of areas around Australia, especially over the COVID break, which gives me a really great opportunity to look at it. So there's lots of things at play. One of the main ones is socioeconomics and the affordability of each area. Okay, so when we look at the socioeconomics, fortunately, the government actually do that for us. There is a scoring system that the Australian Bureau of Statistics put out. It's called the Index of Relative Social Advantage and Disadvantage. They rate each area between 1 and 100, or 1 out of 10, depending on what platform you're looking at it at. I'm going to talk about it in the context of 1 to 10. And one of the examples, I live on the Sunshine Coast, and we are buying property at the moment in the Melbourne area. So I went and wanted to find a suburb in the Melbourne area that had really similar fundamentals, so I could give a really black and white comparison. And the one that came to mind, or the one that I researched and found, was called Geelong. So I'm going to talk about Sunshine Coast as the LGA, local government area. As a whole, the ERSAD score, Index of Relative Social Advantage and Disadvantage, is an 8, and so is Geelong, right? So socioeconomics is the same, median household income is roughly the same. So that doesn't really play a role, they're equal, okay? So back in 29, the median house price, or the typical house price in Geelong and the Sunshine Coast were exactly the same. They were about $680,000. Fast forward now to 2025, and you're looking at almost $1.4 million on the Sunshine Coast. But Geelong really underperformed. It's only $880,000. Now, let me break down again why. Internal migration. There was huge population growth on the Sunshine Coast. There was lots of demand. There was lots of people moving here. There was lots of competition for houses. The amount of stock that was on the market was dropping, which is another supply indicator. And the days on market was also reducing, which is a demand indicator. So you can imagine, right, if you've got lots of people moving to Sunshine Coast and you've got people leaving Geelong, or it's staying stagnant, and you're still building houses here and you're still building houses here, but you're not keeping up, what's going to grow? Obviously the place that is getting lots of population growth. Population growth is one of the indicators that we look at, but it's not the be-all and end-all. By all means, jump onto the Australian Bureau of Statistics and have a look at all these charts. You can have a look at different suburbs or different local government areas to see what the recent population growth was and what the population forecasts are. A great place to start. But there is another part to this puzzle that you need to look at too. And I talked about it earlier, which is supply and demand. Now, there are supply indicators that you can talk about that are short-term, and there's other ones that you can look at that are long-term. But the most common ones that I'm assuming some of you may have at least heard of is called stock on market. Now, trends are more important than current. Now, what I mean by that is if you're looking at just what the stock on market is today or this month, you're looking at a very small window. What you want to have a look at it is over, say, 5 years. Is the amount of stock that's on the market, so how many houses are on the market for that particular area, reducing, right? So was it 2% of the properties in that suburb or local government area 5 years ago and now it's 1? That means the chart is going down. That means stock on market is reducing. That's good. We're having reducing supply. The next thing that you look at is days on market. That is a demand indicator. These are some of the really basic ones, but will be a very, very good start. Over the last 5 years, over the last 1 year, is the chart reducing? Was it taking 60 days to sell houses and now it's only taking 25 days? If it is, that's good. If the amount of time that it's taking to sell a house is increasing, that's not a very good sign. But don't just look at it over a 1 month or a 2 month window. It's not very accurate. The next thing that we will look at is inventory. So inventory is a mixture of both supply and demand indicators, the first two that we talked about. It's basically how many months it's taking to sell a house based on how much stock there is and how many days it's selling. Another demand indicator that we look at is vacancy rates, rental vacancy rates. Ideally, we want this to be reducing as well. If there's lots of people moving to the area, if there's lots of demand for people to have roofs over their head, they may not just be buying. But if the rental market is getting snapped up very, very quickly, that is very good for both looking at future rental growth, obviously. If there's lots of demand and there's more people that need a rent than there is actually houses overhead, it means you can bump up the price of what you're charging for rent. Another thing that we look at is building approvals. Building approvals is a really interesting one. Building approvals, you can look at to see how many building approvals are in the area. This is a supply metric. What's really interesting about this one is it actually gives you a bit of a indication of the supply that's coming to the market over the next 3 years. If there's lots and lots of building approvals at the moment relative to the area, that will mean that there is quite likely going to be an influx of supply coming into the market. Now, again, don't look at this just on its own. Put some context around it. How does it actually compare to the population growth? Like, if the population forecasts far exceed how many building approvals are there, then that's not really a problem. But if there isn't a population forecast that is going to outweigh the amount of building approvals that are in the area, that means there's going to be lots of stock on the market and there's going to be less demand because people are going to have selection. They're going to have choices. They can go out there and put multiple offers, lowballing multiple properties. It's not going to drive the property prices up. Another thing that we look at is the hold period. How long are people holding these homes for? Now, this can mean two different things, right? It gives you a bit of insight on the sentiment of the area. If people are holding their properties for a long period of time, say they're holding them for over 9 years or 8 years, that's a good sign that people like to live here. They want to stay here. If they're dumping them after just a couple years, then it's quite likely that there is a high proportion of investors in the area that are dumping, or there's just not much going on in that area. There's better options around. The other thing is the longer that people are holding their homes for, the less they're selling them. There's less supply filtering back into the market all the time. Now, I know I've ripped through these really, really quickly, and how they actually correlate to what your brief is will change a lot. I wouldn't be able to go through that all right now. It's just simply not possible, or we don't have enough time on this podcast, but I will dive into a lot of these metrics a lot deeper. As you guys know, this is the evidence-based investing podcast. So that's what we're going to do. We're going to show you how we actually use evidence, how we use statistics, how we use data to increase the probability of a better outcome. Now, there's some other bits and pieces that are definitely worth mentioning. Affordability. Now, there's lots of different ways that people will calculate the affordability of your area. For the affordability index, we look at the median household income, which is government data, and we look at the median house price. We then will say, okay, if the median household income spent 50% of their income to repay their mortgage on a property they put a 20% deposit down on in this current interest rate environment, how long would it take them to pay off? This is where it gets really interesting, right? This is where I start to see friction points. So I'm going to bring it back to the Geelong and Sunshine Coast example again. And when I'm talking about the affordability of the area is where you look at the median household income and you look at the median house price. If that median household income spent 50% of it to pay their mortgage on a P&I interest with a 20% deposit, so 80-20 loan-to-value ratio, how long would it take them to pay off? On the Sunshine Coast at the moment, it's 70 years. We ain't doing 70-year mortgages, right? In other words, it's starting to become very unaffordable for its residents. It begs the question, are we coming to a bit of a time where it's a bit of a friction point? Is it starting, if there is people that can't afford it that live there, how do we keep increasing the demand? Sure, not everyone is going to be putting down only a 20% deposit. A lot of the residents in the area have bought property before COVID and they have a huge amount of capital in the property. If they sold down, they could put down $500,000, $1 million deposit on the next property. But it's still becoming unaffordable for its residents that are not in the property market, which means there's less demand that's coming to the market. And I don't mean in the next month or 2 months, or maybe not even the next year. But the data shows us, and if you do regression analysis, that this is usually a bit of a friction point. It is less likely, based on history, that a area that has 70 years on average to own will double in the next 10 years, which a lot of people are always trying to achieve, than it would if you get into an area that is less than that. Let's say under 40 years. Now, we talk about Geelong. Geelong is just under 40 years to own based on those same metrics. So there's more people in the area that can afford to buy that. And by the way, we do actually offer 40-year mortgages these days. There's some other bits and pieces that you want to have a quick look at when you're looking at a suburb early on before you get too deep. Now, if it's an area that's prone to flooding, for example, go get insurance quotes. You might find that the insurance quotes for that area could be uninsurable completely, or it might be $5,000, $6,000, $7,000 a year to insure a property. That would kind of rule me out. It just starts to make no sense to buy there anymore. The cash flow on a property like that would be really bad. But what's even more important than that is the economic diversity. If the economic diversity is scored badly, I run for the hills, especially if you're looking to invest long term. Now, that's not the case for everybody. Sometimes people want to go into an area that is a mining town for a particular reason. I don't. I think it's just far too risky. But if you were very, very diverse in all other areas and you were looking for somewhere that had short-term growth, it is a possibility. It is something that you could do. I don't put my clients there, but it is an option. Now I want to talk about economic diversity. Economic diversity is how diverse the jobs are in the area. So one of the main examples that most people would understand and resonate with would be mining towns. If everybody is working for that one economy, that for the mining industry, then what would happen is that if that mine shut down for whatever reason, it might be geopolitical, the gas prices might plummet, there might be an advancement in technology for some sort of other electricity. What will happen is that everyone loses their jobs, therefore everyone leaves town. If everybody leaves town, there's no demand left again. Again, we're going back to supply and demand, guys. If there's no demand and there's still all the same amount of supply, like you're not going to pick these houses up and move them overnight, then the property market will drop. Like there's nobody wanting to buy there. Everyone's trying to sell. If everyone's trying to sell, then basically it's a race to the bottom. It's a really, really risky strategy. It's something that I would stay away from, but it's something that you definitely need to look at. Again, all of this is available on the Australian Bureau of Statistics website. I use paid platforms to speed up my process because I do so much of it. But, again, it is really, really important. The next thing I'll look at is infrastructure spend. Now, I'm not looking at talking about infrastructure spend for one-time projects. I don't want to just see a highway upgrade, although, it will help. And for certain areas around that, it might open up a way to get to the beach quicker or get to the shops quicker. So you can have a look at that for certain pockets. But what I really am talking about is things that are going to drive jobs, not just in the short term, but the long term. Things like hospitals, things like schools. If there's a major hospital precinct going in, it really makes a difference, not just because of the jobs that it creates for the nurses and everything, but there'll be a whole demographic that will be quite likely to move there. If they can move and you're a bit old and you need to have some support by hospitals, you want to be close for your health, then you could move there. So there's time and time again, there's so much research out there. You can go have a look at where major hospital precincts are happening. You can see the price growth that happened afterwards. The other projects that you can look at in the pipeline is things like education, because schools are another one that we like to look at. Not only does it increase the jobs in the area, teachers, all the rest of it, but it also increases the likelihood of families wanting to move there. If there's a good school in that area, it's a really big decision for families. It does make a difference. If there's good schools in the area, people are more likely to move there. Transportation's another one. You want to make sure sometimes that, depending on where you are, you might want to be close to sort of tram lines if you're in near cities. And public transport is the way that everybody gets around there because of parking and all the rest of it. Tourism is another one. If you're in an area that is getting some major upgrades to increase the amount of tourism that's in the area, that can be huge benefit, especially if you're looking at strategies like Airbnb. Now, an overarching metric that I do look at here is the gross regional product. Is that increasing? I'm not going to get into that too deeply at the moment, but again, it's statistics that are online. This is government data that I'm talking about. I'm not making these points up that I'm talking about. This is all government data that's derived from things like censuses and just ATO and all the rest of it. And then there's one last thing that I look at. Well, it's actually not the last thing, but there's one other key metric that is definitely worth a mention, and that is rent to owner occupier ratio. You want to keep that sort of below 30, 35%. Sometimes you can creep up to 40, but honestly, depends on the brief, depends what you're trying to achieve. And it depends on the area too. Like if it's in a high tourist area and you're trying to do an Airbnb model, then obviously it's likely to be a lot higher. Again, whenever you look at this sort of stuff, compare it to other areas that are suitable for your brief, that have done what you wanted to do in the past. And don't just look at one suburb. It's like all well and good saying this is good, but it's good in comparison to what? When the rent to owner ratio gets too high in suburbs that are your typical suburb, it starts to ring alarm bells to me that there is starting to become a lot of investor demand in that area. And when you pair that with things like high affordability rates, so it's starting to become unaffordable for its residents, and if you see vacancy rates, for example, starting to go up, that would be an indicator for me to start looking at the idea of getting out of that market, possibly selling down. Now, there is so much to this. There's not a black and white answer, but these are some of the indicators that we look at where we say, okay, it's starting to get to a friction point, it's starting to become unaffordable for its residents, especially because the social economics are low. There might be a 2 out of 10, for example, and it's 40, 45 years to own, and the vacancy rates are increasing, and the rent to owner ratio is getting higher than that 35, 40, 45%. When you see these indicators and you look back at suburbs and these metrics over a long enough period of time, you will see that there is a high correlation to all of these things coming together that will make it likely that this market is about to flatten out, to drop off, or to not keep increasing at the rate that it was currently increasing at. It depends if the type of asset in your suburb is the typical one. Does it actually sit in within this affordability area? Is the typical price in line with what the typical price of the suburb is, or is it lower or higher? So the next thing I want to jump into is how we define a cold spot, a warm spot turning into a hot spot, and a hot spot. At a very high level, I don't want to get too into it at the moment, but at a very high level, it very much comes down to the last year's price growth. If an area has increased at, say, over 12% in the last year, we would call that a hotspot. And there is some other metrics around that, for example, like days on market, that we need to look at to sort of confirm that that is actually the case. Sometimes when you're looking at data, it's not always as it seems, and sometimes it needs a bit of a deeper dive. For example, if you're looking at a suburb that's only got 5 sales in the last year, it's very easy for the median price to jump up 10 or 12%. So we would usually just exclude any sort of suburbs like that when we're doing our data analysis. And also, when you look at the days on market, it's really important to actually ring up the agents in the area to understand when they are actually pressing the sold button on realestate.com. Because a lot of time when you're looking at the days on market metrics, that's the way that metric is actually derived. It's looking at the day that it was listed online to the day that it was marked as sold. Now, depending on, again, where you are looking at the data, this may or may not be the case, but it's something that you need to keep in mind if it is, because if there is a real estate agent that doesn't mark their stuff sold until it goes unconditional in one suburb, and that is the standard practice for that suburb, obviously the data is not going to look as good as if there was a suburb where the industry norm was to mark things as sold as soon as they had a unconditional offer. It can change the days by 14 days quite easily. So again, very, very important to understand the actual numbers behind those metrics when you're looking at data. It can be skewed by, human intervention. That is a really good example. But going back to what I was talking about before, when we're talking about a warm spot that's transitioning into a hot spot, typically that would be somewhere between sort of 2 and say 8, 9, 10% growth. If it's over sort of 7% growth, we would call that a hot spot. 7 to say 15, and then anything over 15 would definitely be well and truly into that hotspot territory. We don't have sort of black and white indicators on that. It will change a little bit depending on how much population is in there. Now, one thing that you need to start to understand is how much growth has it had over not just the last year, but the last sort of 5 years. Where is it in its cycle? If an area has increased by 100% in the last 5 years, and the other metrics are saying that the demand is dropping down, affordability is starting to hit a friction point, population forecasts aren't looking very good, I would look at that and say it's unlikely that that is going to double again in the next 5 years. Compared to and I'm saying compared to because it's always in comparison to something else. There's always different areas in and around Australia that are moving at different cycles. If you compare that to an area that has had only 10% growth in the last 5 years, but the last 1 year of that has been the 10%, so it's starting to get momentum. Its affordability is really, really good. Population growth is really, really good. The building approvals are low, and the stock on market chart is reducing. The days on market is reducing. The vacancy rates are reducing. Then I would say it's a lot more likely that that's going to double in the next 5 or 10 years. So when we talk about warm spots, hot spots, cold spots, they all have a place for certain people, for different briefs. It's not as simple as just saying, let's get into a hot spot, let's get into a hot spot, let's get into a hot spot. Sometimes if you don't have the finance to actually remortgage again in 1 year, it's actually detrimental to get into a hot spot. And the reason being, and I've talked about it before, is because if it's already halfway through its cycle, if it's already moving at 20% and it has for the last 3 years, it's unlikely that it's going to keep moving like that over the next 10. You're better off getting into another area where it's had quite small growth in the last 5 or so years, but it has the fundamentals to start increasing soon, i.e. reducing stock on market, reducing days on market, reducing vacancy rates. Building approvals are low. The index of relative social advantage and disadvantage is at a level that correlates well with what the affordability is. In other words, if it's a 8 out of 10, we can go a little bit higher in the amount of years for the affordability because the socioeconomics of the area is higher. In other words, people are more likely to be able to afford that a little bit better. There's more educated people in that area. They're likely to have more money saved up because they're more educated. They understand investing, etc., etc. If it's in an area where the ERSAD score is lower, say a 1 or a 2, then we want that affordability to be very low. But it doesn't really matter about the actual ERSAD score itself. I've done a regression analysis on this, and the difference between a 1 and a 10, if you look at that in isolation, is very little on its own. If it's in a lower bracket area, though, it does start to make a little bit of difference when you get higher. And what I mean by that is you wouldn't want to go buy a property that for $2 million with an ERSAD score of 1. You know, the people in the area are not educated as much as people that are at 10, and therefore it's very unlikely that is going to go from $2 to $4 million. If it's an area that's at $400,000, it's a lot more likely for it to go to $800,000. And I have done regression analysis. I've done this case study on this. It is true. It is correct. I have looked at this evidence. But getting back to what I was talking about before, there is different times for you to buy different properties in different suburbs, which might be in an area that is hot, that is warming up, and it depends on what you need in your portfolio at the time. There's obviously you need to balance what your yields are. Your cash flow is your oxygen. That's what keeps you alive. That's what keeps the portfolio moving. That's what makes sure you don't go broke. That's what makes sure that you can afford your repayments and all your maintenance. But you also need to understand what your finance situation is, not for this property, but the next one and the next one and the next one. When can I loan again? When am I likely to have the serviceability to get more money from the bank to buy the next property? If your goal is to build a property portfolio. If you are looking to build a property portfolio, you want to work out when can I loan money now? When am I likely to loan money again in the future? And how can I align my finance plan with my filtering of my suburbs to get myself into a suburb that suits my property portfolio. I don't want to get into an area that's a hotspot if I can't loan again for 5 years. There's no point. It's likely that that's going to go up in value over the next 5 years, and then it's more likely that it will drop compared to going to an area that has been really steady over a long period of time. And if you can get to that 5-year mark, get enough equity out to fund deposit for the next one, and the long-term averages are better. In other words, over a 10-year cycle, you actually make more money than if you're going to hold the property for 10 years. What matters is that it doesn't stop you in your property portfolio building. In other words, you have the equity to get it out to fund the deposit and costs for the next property to keep you moving, and that it does the job that you want it to do over the 10 years that you're going to hold it, for example. There is no point buying a property that goes up in value really quickly over the first 2 years. If you can't pull that equity out, you can't do anything with it. And then over the 10 years, you end up in a worse position. Understand your goals, understand what it is that you're trying to achieve, make sure you plan this all out, and make sure that you pick a suburb that is going to increase the probability to get you that particular outcome. There is a lot that I've gone through in this. I'm going to leave it at that. I'm going to dive into each one of these metrics in a lot more depth over the coming episodes. I hope that was enjoyable. I hope it wasn't too confusing. And until next time, thank you.